Good afternoon and welcome to BizTech's ASEAN Midday Market Watch. Our guest today is Stephen Innes, Chief Global Market Strategist at Axie. Steve, as always, great to have you on the show.
Thanks for having me, Brian. Great to be back on again.
Now, Steve, before we get your insights, let's take a look at how markets in the region are performing. Now, it's a sea of green today. We've got the Nikkei at 29,954.31. It's up 0.64%. The Shanghai Composite is up 0.24% at 3,428.08. The Hang Seng is at 29,012.96. It's up 0.62%. ASX 200 is up 1.07% at 6,845.4. And rounding up, we've got the Kospi, which is at 3,060.69. It's up marginally 0.49%. What's your view on this exuberance around markets?
Well, the market's making a big deal out of the stimulus and the fact that the Feds are probably not going to rock the boat in the sense that they're not going to come out too hawkish. But I also think to a large degree, especially in Asia here, the stronger than expected activity data in January and February in China continues to resonate. And if you add the 1.9 trillion stimulus package that the U.S. will lead with, which should drive U.S. sentiment and also global growth sentiment. Seems to be a lot more synchronized global growth narrative hitting the markets today, and this is really good for Asia exports. And this is really at the heart of the argument here. As exports start to lift off, I think this is where Asia stocks can climb, and I think the markets feel pretty good about that narrative on the reopening trade.
Now, Steve, and as you correctly pointed out, that's this dominant narrative of synchronized global growth. But is that going to have a lot of impact in terms of the U.S. Domestic market itself?
Yeah, and look, at the U.S. is a big consumer, like the biggest consumer next to China. I mean, they'll battle it out, but. Recover, opening up, or, Vegas is going to be opening up soon. The beaches are going to be opening up soon. Restaurants are going to be opening up soon. This just suggests to me that, Asian markets are going to start exporting more machinery, even electronics, you name it, they're going to be shipping them more to developed markets. This is pretty good. Of course, Europe's a little bit of a laggard in this move right now because vaccination problems, but they're going to catch up too. So I think things are looking quite positive on the reopening narrative.
And still on this topic, in terms of the sectors we should be looking out for in Asia on this recovery story, where would you be putting your money?
In the airlines, last week Boeing was up. Boeing was up 20%. That was a great trade. But I think everything that looks to be on the reopening narrative, whether it's the hospitality sectors, whether it's anything around tourism, is going to start picking up. Look, we still have some problems around tourism because of the quarantines and the reluctance of governments to actually open up borders right now. But we're getting close to that. Markets generally price in that effect, a couple of months ahead of time. So we're getting to that 8-week window right now where some of these reopening trades and around travel and what have you are probably going to look a lot more attractive. So, people are opening their horizons. They're not necessarily rotating because they've already dumped, markets already dumped a lot of tech stocks. The NASDAQ went up last night, regardless of higher yields. There's a lower sensitivity to higher yields in the market right now. So, everything looks pretty good again. It looks like a very rosy outlook. And why not? Because ultimately the U.S. consumer is going to go on a spending bonanza, and that spending bonanza is going to feed directly through to corporate profits and earnings per share. And this is why stocks continue to rise, in my view.
Now, yesterday oil traded at above $70 for a while. What's your view on oil markets, particularly on the supply side? Do you see more upside in oil prices in the coming weeks?
It's difficult. It's just a constant, shift in momentum on oil. It's very tough to find an equilibrium for any longer than a 72-hour period when it comes to oil. There's a lot of issues, in the markets right now, especially around the supply side. that are quite uncertain. Iraq coming back to the markets with barrels. Will there be some fractures in the OPEC discussions? Will shale become more responsive to higher oil prices? These are constant dialogues in the background, but more to the point right now, this unlikely build in U.S. inventories that wasn't really being expected, it's sort of causing a bit of a hiccup, because remember the WTI settles on Monday, on March 22nd. So there's some rollover issues here. We've got a lot of barrels in the market. Market's very long. They've got to sell these barrels, and the market knows that. And they know these are deliverable, the WTIs, and people aren't buying. And that seems to be the problem. There looks to be a bit of a technical correction in the markets right now. This is why I've advocated going out the curve for investors who want to trade oil. Get away from this front end stuff and stick to the back end. Go a few months out on the curve. Ideally, December looks to be probably the ideal spot to go long. The premium doesn't look that expensive, and it was a pretty good idea. And now that idea is coming back to fruition. These were suggestions just to get away of all this front end mess that's happening in the markets, especially due to the unexpected inventory climbs.
Now, Steve, final question. FOMC meeting for the next 2 days, starting tonight. Besides that, what are events and markets are looking out for this coming week that are really going to move markets?
I have a view that the FOMC, although they're not going to admit, is becoming more market sensitive than they are data dependent. And the reason for that is they're quite aware of the fact that if they hint at raising interest rates, stocks are going to slide. So what are they going to do? Well, they're going to hold investors' hands through these not so dovish and not so hawkish goalposts that they're going to calibrate over the next 48 hours. And I think it's going to be more of a Goldilocks scenario, but there's not going to be any rabbit hole to fall down. And this is going to be endearing for investors. Look, we're looking at the way how rates volatility has become somewhat depressed, and we're looking for reasons for that. I don't necessarily believe it's because yields aren't going up, but I think the systematic risk that markets were embedding in higher bond yields, in other words, as more supply comes to the market, there could be possible market dysfunction. This was really worrying investors to a high degree. But on the other hand, now there's lots of discussions emanating from Japan covering a lot of these tenders that are going to be coming up. And this is a good thing. So this has sort of deflated a lot of the risk premium. And why not? The spread to JGBs and US Treasuries right now is the highest it's been in years. So there is a good rationale here to be built that Japan could come to the rescue of the US supply issues when it comes to bonds.
Now, Steve, as always, thank you very much for your insights.
Thanks for having me, Brian.
Now, we've been speaking to Stephen Innes, Chief Global Market Strategist at AXI on BizTech's ASEAN Midday Market Watch. I'm Brian Fernandez. Check out www.biztech.asia for business and technology conversations.